we can create now the adjusted trial balance. And the adjusted trial balance is simply another version of your trial balance, but it's just the version that is updated for your end of the period adjustments. So what you can see here, this is just basically, you can do this in an Excel document or any type of spreadsheet software. But what we have here is our unadjusted trial balance. Before now we've just referred to this as our trial balance, but now we're going to specify that this is before the end of the period adjustments. So you can see here we just have our various accounts, then we've got our debits and our credits. Then after we have made our adjusting entries, we can create these new columns, and this is our adjustment columns. You can see here we've got the debit and credit columns, and all this does is record our adjusting journal entries. So let's just look at one of these. We'll look at A, for example. You can see here A, we have a debit for $100, and up here is the other side of journal entry A for $100. And you can see here this journal entry was the one for insurance expense. That was where we were expensing $100 for every month that passed. So here we have insurance expense, and that's why that's debited, because that's where we had an increase to our insurance expense. And then over here our credit, that's just where we were decreasing the prepaid insurance or decreasing that asset. So again, when you put these items into the adjustments column, you've already done all the work. You're simply transferring it into the trial balance or your worksheet. Next, we can now add the adjusted trial balance, and all that is doing is summarizing what the unadjusted trial balance was plus any adjustments. So for here, when we make adjustments, we don't make adjustments to cash, so there's going to be no change to cash, so all you do is simply bring this balance and leave it in the debit side. Here, accounts receivable, we had nothing in accounts receivable, and then we added $1,800, so we'll carry that over. Then let's look down here. We'll just scroll down a bit. You can see here, for example, unearned consulting revenue. We had a liability of $3,000, but during our adjustment process, we had earned $250, and that's why we're debiting this liability here in the adjustments column. So these we will subtract $3,000 because this is a credit balance because it's a liability, minus whatever reduction in the liability, leaves us with a remaining liability of $2,750. If you'll notice here, keeping in mind this is a trial balance, meaning at any point it should always balance, meaning your assets plus your liabilities and stockholders' equity should be in balance, or they should be equal. We can check this by making sure our debits and credits balance, and you can see here the unadjusted trial balance, they agree. Our adjustments, we are in balance. And then finally, if we've done all of our arithmetic correct here, you can see that we balance again. So this is just our adjusted trial balance, meaning it is after we have had our adjustments. So now let's look at, once we have made our adjustments and we're closing things out for the period, we can begin to create our financial statements, and we'll do that from the adjusted trial balance. We do this in a specific order, and that's because in order to create certain statements, you need information from the previous statements. So we always begin by preparing our income statement, and if you'll remember, income is revenue minus expenses. So we will pull all of the revenue and expense accounts off of our adjusted trial balance. From there, we will calculate our income. Next, we'll create our statement of retained earnings. If you'll remember, retained earnings is made up of your beginning retained earnings balance plus any income, or if you had a loss, you would subtract that. And then if you had any dividends, that would also reduce your retained earnings. So our second statement is the statement of retained earnings. The reason we make this second is because we need to know our income from the current period. So we use the income number from the income statement in order to create our statement of retained earnings. Next, we'll create our balance sheet. A lot of students confuse a trial balance and a balance sheet. The difference between a trial balance and a balance sheet will be more obvious on the next couple slides, but a balance sheet only includes your assets, your liabilities, and your equity accounts. So your equity accounts are your common stock and your retained earnings. The difference there is because retained earnings is going to include all the information from the statement of retained earnings. An adjusted trial balance, rather than having an updated retained earnings, meaning updated for the current year, your adjusted trial balance includes all of your specific accounts that go into or roll up into retained earnings, meaning that if we come back here to our adjusted trial balance, we show all of the specific dividends, consulting revenue, various revenue and expense accounts. This is a trial balance because it includes all of these accounts, and we'll describe a process as we move on into the next section of this chapter called the closing process. Dividends, revenue, and expense accounts are what we call temporary accounts, meaning that they are temporary. The balances within them grow over the year and they start over at the beginning of the year. So how do we get rid of those? They don't simply disappear. All of these temporary accounts, dividends, revenue, expenses, roll up into retained earnings. So when we have an adjusted trial balance, you'll see we have all of our asset accounts, we have our liability accounts, and we have our equity accounts, and then we also show our temporary accounts. When you have an actual balance sheet, these temporary accounts are not going to be listed on the balance sheet. Now, the information from these temporary accounts does not simply disappear, but instead we go through the closing process and these numbers are closed into retained earnings, because if you'll remember, retained earnings is made up of our beginning balance and retained earnings plus any revenue minus any expenses minus any dividends. So once we update retained earnings, you'll see that all these roll into retained earnings, so we're not going to see them on our actual balance sheet. So you can see here we have our adjusted trial balance. So this is not a balance sheet yet. This is our adjusted trial balance. So we're going to have our asset accounts, our liability accounts, our equity accounts, and then we're going to also show all of our various temporary accounts, meaning our dividends, our revenue, and all of our expenses. So again, this is a trial balance, and from here we can create our financial statements. If you'll remember, we begin with the income statement because we need the information from the income statement in order to create our statement of retained earnings. So here, this is just the same trial balance that we saw on the previous page, and we can create our income statement from there. The income statement includes all revenue and expenses. Here is our revenue, the fees that we have earned. So our revenue, we'll pull that number here, is $79,000. Then we pick up any expense accounts, and you can see here we have two expense accounts. So our net income for the year is $15,000. Now we will use this net income number in order to create our statement of retained earnings. So here, just a summary of the income statement we just made. And now let's create the statement of retained earnings. We'll begin with any beginning balance that there was in the statement of retained earnings. So this is coming from our adjusted trial balance. $45,000 is our beginning balance. We add to that any net income, which is what we calculated above, and then we'll subtract out any dividends. You can see here we had $20,000 in dividends, so we subtract that. And our ending retained earnings is $40,000. So what we have done here is you have now figured out what is going to be on our actual balance sheet for retained earnings at December 31st, 2015. So let's go back over here. This was our adjusted trial balance. At the end of the previous year, or at the beginning of this year, or before we have closed everything, the number that we see here in retained earnings is before the closing process. So this is our beginning balance in retained earnings. This is on our adjusted trial balance. When we create our balance sheet, which we're going to do on the next page, we will no longer use this old retained earnings number. And the reason we won't is because all of this information, dividends, revenue, salaries, expenses, and office expenses, all of this information now is going to be rolled up into our new retained earnings number. So on our balance sheet, the new retained earnings number is going to be $40,000 because that $40,000 is going to be updated for this year's income. So that's going to include our revenue and all of our expenses and any dividends here. And that's why our new retained earnings on our balance sheet is going to be $40,000. Then on our balance sheet, because the retained earnings number is updated and it includes all of the temporary accounts from the current year, we will not show any of these temporary accounts on our balance sheet. So let's see how that looks. Again, here's our trial balance. We created our income statement. We used the income statement number to create our statement of retained earnings, and then we can create our balance sheet. A balance sheet is basically like a snapshot of our company. It's going to show us the balances in all of our various accounts at the end of the period, and in this case we're looking at December 31st, 2015. So first we'll show our assets. So we've got our asset accounts here, cash, accounts receivable, and land. We'll simply show those here for a total of $115,000 in assets. Then we show our liabilities. We had accounts payable and long-term notes payable are our different liabilities for $45,000. Again, common stock, we're just pulling that from right here on our adjusted trial balance. Common stock is $30,000. Then we use our retained earnings number. If you were to pull this $45,000 off of the adjusted trial balance, you would find that your balance sheet would not balance. If we had $45,000 here, our total liabilities and equity would be $120,000. Our assets and our total liabilities and equity need to be the same. So make sure that you don't pull this old retained earnings number. Instead, we need the new or the updated retained earnings number. So $40,000 is going to be down here in our equity. And keep in mind that this is a balance sheet, so we're only going to show our permanent accounts, and that's because our temporary accounts, which includes our dividends, our revenues, and our expenses, all of this information is rolled up into this new retained earnings number. So you can see here that our balance sheet is in balance because our total assets equals our total equity. We're now going to learn a series of new journal entries that are called closing entries. And these are entries that are necessary to close out our temporary accounts. Temporary accounts are those items that we close into retained earnings. So again, I mentioned those a couple slides back, but the temporary accounts are revenue, expenses, and dividends. And from the previous couple slides, you'll remember that we close those into retained earnings. So these are the entries that actually show how we do that in your accounting system. So when we close an account, this means we want it to be zero. So in order to do this, we'll close our credit balances in revenue to income summary. We'll close the debit balances in expenses into income summary. Once we've done that, we will close income summary into retained earnings, and then we'll close dividends directly into retained earnings. So basically all we're doing is if an account has a balance, we need to zero it out. So if a revenue account has a balance, that means it has a credit balance because you increase revenue with a credit. So in order to close it, we need to debit that revenue account, and the other side would be a credit to income summary. The same thing here. If you have a debit balance in your expense account, in order to get rid of it, you need to credit it. So anytime we have a credit, we also need to have a debit, so then we would debit income summary. You then look at whatever balance you have in income summary, and you close that out with either a debit or a credit, depending on if you had income or a loss, and we close it into retained earnings. Dividends does not go through income summary because dividends are not part of your income. Dividends are simply a reduction to retained earnings. So we'll close that directly to retained earnings. Let's look at how we actually do this. So here we just have our adjusted trial balance, and we need to close our temporary accounts, because remember, our temporary accounts include all of the items that end up rolling up into retained earnings. They are temporary accounts because these balances build during the year, and we close them or zero them out for the start of the next year. So we will close out dividends, revenues, which here is fees earned, and then any expense accounts that we have. So let's go through this actual process. So the key here is to keep in mind that revenue typically has a credit balance, and the goal here is to make our revenue account zero. So in order to make something that has a credit balance of zero, we will need to debit revenue for the full amount. So here you can see we are debiting revenue or fees earned for $79,000. Because if you had a credit balance of $79,000 and then you debit it for $79,000, this brings the fees earned account or the revenue account to a balance of zero. Anytime we have a debit, you also have to have a credit. So where do we close revenue to? We close it to income summary. So because we already have our debit in order to zero out revenue, we now need a credit, and that credit is going to go to income summary for $79,000. So you can see here, here's our income summary account, and you can see here this credit for $79,000. Next, we need to close out our expenses. Where do we close them to? We close them also to income summary. So you can see here we had two expenses, and expenses by rule have a normal debit balance. So in order to get these to zero, we need to credit them for the full amount. So you can see here we credit salaries expense and office supplies expense for the full amounts. Because when you have a debit for $56,000 and then you credit that same account for $56,000, that brings the balance of salaries expense to zero. You then do the same thing for your office supplies expense. It had a debit balance of $8,000. We credit that same account for $8,000, and we have brought that account to zero, so we have closed it. Because we had two credits, which equal, when you sum them together, $64,000, we know we need a debit for the same amount in total. So here we are going to debit income summary for $64,000. Here you can see our revenues were $79,000. Our expenses totaled $64,000. So that leaves us here, because the credit side is bigger than the debit side, we show the ending balance, which is net income, on this side of $15,000, and that's just the difference between our revenues and our expenses. The next step is we need to close income summary. Income summary currently has a credit balance of $15,000. So in order to close income summary, we need to debit it for $15,000. So you can see here we debit income summary to $15,000. And then by rule, the total amount of your income goes to retained earnings. So we are closing income summary to retained earnings. Because we had a debit of $15,000, we need a credit of $15,000. So here we are closing income summary to where? We close it to retained earnings for $15,000. And let's just think about this. If you'll remember, by rule, retained earnings is an equity account. And equity decreases on the debit side and increases on the credit side. If we had net income should increase retained earnings. So what happens here? When we close out income summary, we close it to retained earnings, and we do that by crediting retained earnings. So in the end, this income has a credit effect to retained earnings, which increases retained earnings. The final step in our close process is to close dividends. We close dividends by getting rid of any balance in this temporary account. By rule, dividends have a debit balance, So in order to get rid of this balance, we'll need to credit dividends. You can see here we're crediting the dividends account. And where do we close dividends to? We close it to retained earnings. And let's make sure that this makes sense. Again, retained earnings is an equity account. Equity decreases on the debit side, increases on the credit side. Dividends are a reduction in retained earnings, meaning they have a negative effect to retained earnings. So when we close dividends into retained earnings, we do that by crediting dividends and debiting retained earnings. Remember, if you debit retained earnings, you reduce retained earnings. So the end effect would be our beginning balance in retained earnings of $45,000. Add to that any net income, subtract out any dividends, and here we have the ending balance of retained earnings. And you can see here through this closing process, we have zeroed out our expenses, our revenue, and our dividends, meaning that we have closed them and they are ready to begin recording those amounts for the next year. So now that we've actually gone through all of the closing journal entries, that shows you where the updated or the final retained earnings number comes from. Because if you'll remember, on the post or the pre-close trial balance, our balance in retained earnings was $45,000. And then we go through the closing process and we end up with the ending balance in retained earnings of $40,000. So that's just a summary of how do we actually get to this number. Now we can look at what we call the post-closing trial balance. And the post-closing trial balance is just yet another trial balance. But this trial balance is only going to list the permanent accounts and their balances after we have completed the closing entries. So we'll have our permanent accounts, and that means we're going to have all of our accounts besides the temporary accounts. If you'll remember, temporary accounts are our dividends, our revenues, and our expenses. Really nothing between the pre-close and post-close trial balance is going to change besides the fact that we get rid of some accounts, and our retained earnings number is going to go from the pre-close amount to the post-close amount. So here you just have a snapshot of an example of a post-closing trial balance. And what you'll notice here is that we have all of our assets, all of our liabilities, and then we have just two equity accounts. We have common stock and retained earnings, because all of those temporary accounts are eventually closed into retained earnings. So that's why we don't show anything beyond retained earnings. So here we just have a summary of the steps in our accounting cycle, and this is all things that we have already done. You analyze a transaction. Once you've done that, you're identifying what type of accounts are there, what is your actual dollar value. So you make your journal entries, you post those, prepare your unadjusted trial balance. You then make any adjusting entries. From there you have your adjusted trial balance. You can create your financial statements. You go through the closing process and you can agree your financial statements to the post-closing trial balance. And then if you need any reversing entries, you'll do that. We've really not talked about reversing entries, but typically a reversing entry is something that you would do if there's a mistake found. You simply reverse the original entry to net that effect to a zero. So here we're going to look a little bit more into a balance sheet, and we call this a classified balance sheet. We call it classified because we're going to have different classifications of the items on our balance sheet. Specifically, we're going to classify our assets and our liabilities. First, let's look here, assets. When we make a balance sheet, and if you go back in previous chapters, you'll notice that your balance sheets are set up in this order, but we haven't called it to your attention yet. So when you create a balance sheet, there is a correct order for your assets. You'll begin with your current assets, and those are the assets that are typically only going to last a year or a normal operating cycle. Things like cash, short-term investments, things like that. Then we have the non-current or the long-term assets. So these are typically things like your property, your buildings, your equipment, things like that. Anything that's going to last for more than a year or an operating cycle. Then we can look at our liabilities. Liabilities are going to be classified between current and non-current liabilities, and then we'll have the equity section. We're not going to dive too deep into equity right now, but as we move on, you'll see there are different types of classifications of equity, mainly different types of stock. But again, that's beyond this current chapter. So current assets are those things that are expected to be used or sold within the current year. Long-term investments is anything, again, for a longer time. Plant assets, those are typically any type of machinery or things that you're going to be using. Intangible assets, if something is intangible, you can't touch it. So an example of an intangible asset would be something like a patent. A patent has value, but it is not an actual machine. Instead, it is legal documents that protect information. So that's an example of an intangible asset. And things like patents, copyrights, trademarks, so they all have different lives that are defined by contractual terms, but all of those are greater than a year. So if you have some type of intangible asset, that's going to be a long-term asset. Current liabilities are any types of obligations that are due in less time than a year or the company's operating cycle. Typically, this would be things like your accounts payable. Most companies pay those on a month-to-month basis. Long-term liabilities are anything that are not going to be due within the current year. A good example of this is if you have a loan with a bank. It may be a long-term loan, 5-year loan, 10-year loan, things like that. And equity, again, we just have a definition of equity, nothing new there. It's just the claims that a company has, that the owners have of a company. So here we have our balance sheet. This is just our this is our trial balance. So here we can use this to create a classified balance sheet. And basically all we need to do is to see which accounts go onto our balance sheet and then classify them into the various categories. The first thing that I can tell you here, you can see dividends, fees earned, salary expense, office supplies expense. These are all of those temporary accounts. So when we move from an adjusted trial balance to a balance sheet, we'll need to close all of these into retained earnings. If you'll notice, this is the same example as before. So we've already done this closing process, but just a reminder. So you can see here, these items in red are the permanent accounts that are going to go on our classified balance sheet. So here we have our current assets. That's typically our cash and our accounts receivable. Then we have our long-term assets. Here, the only long-term asset is our land. Then we've got our liabilities. First we have the current liabilities, which is simply our accounts payable. We've got long-term liabilities that includes that note payable. And then we have our equity account. And notice the retained earnings is the new or the post-close retained earnings, $40,000, because all of these temporary accounts have been rolled up into the updated retained earnings number. We're going to end the lecture portion of this chapter by looking at a couple ratios. And ratios are just a way of looking at financial information and computing different ratios that help us to get an idea of how a company is working. So the first here, we're going to look at profit margin. Profit margin is simply looking at how is a company, are they effectively earning net income with their net sales? Because if you think about any company, they can have millions of dollars in net sales. But if their expenses are way out of control, they can end up with very low net income or no net income at all. They could end up losing money. So what the profit margin tells us is that we are making sales, and we want to see of those sales, what is our bottom line? What are we actually keeping as net income? So when you divide net income by net sales, this tells us the profit margin. The higher this percentage, this means the more effective a company is in earning net income from their sales. So you can see here we've got a number of different years of information for a specific company. And let's look here, for example, from 2010 to 2011. You can see here their sales increased. Also, their net income increased. But let's look at what happened to their profit margin. Their profit margin increased significantly. And you can see here it went from 5.2% to 8.4%. So what that's telling us is they had a little change in net sales. You can see here we went from, I would assume this is probably in millions, but let's just read it in thousands, from 8,632 in net sales to 9,613. So basically they increased here by about $1,000. But what happens with their net income? Their net income almost doubles. You can see here from about $448 to $805. So they had a much larger increase in their net income than they did in sales, and that's why we see this large jump in profit margin. Then let's look here, for example, from 2012 to 2013. You can see their sales increased. Not a huge amount, but it did increase. But what happens to their net income? Their net income actually decreased. So even though we saw an increase in net sales, their expenses must have increased because that increase in net sales did not result in an increase in net income. And that's why you see here the drop in profit margin. Now we're going to look at the current ratio. And current ratio is a ratio that tells us about the financial position of a company, and it can help us have an idea of how stable a company is. The current ratio is calculated by dividing current assets over current liabilities. And what this is telling us is what is the percentage of current assets that a company has in order to cover or pay their current liabilities. You want to have a higher current ratio. Typically, if it's a 1-for-1 type ratio, sometimes that can be considered to be dangerous because it means for every current liability coming due, you only have $1 of current assets in order to cover that. So it would be easy for you to all of a sudden something not go as planned and you not be able to pay your liability. So here you can see some examples of current ratios. You see here a current ratio of 1.6 is higher or more stable than a current ratio of 1.4. Oftentimes, if someone's looking at whether or not they're going to loan money to a company and they want to know how likely are they to be able to get their money back, current ratio is a good ratio to look at to begin to get an understanding of the stability of a specific company.